it's important to understand why you have an edge.
Yeah.
The track record that you see is a non-statistically relevant sample size of data. So even if somebody has 10 years of track record, maybe it was in the last 10 years, which has been a raging bull market. So all they've been doing is buying the dips or selling volatility, when it spikes. And so how is that really an edge? Not really, because they're just, sort of fortunate to have the right strategy at the right time. And they have to be intellectually honest with themselves that, I've been playing in a playing field that has been very fertile for what I do. And then the question becomes, can I adjust? Everybody thinks they can, but, can I adjust to a different type of playing field?
Welcome to FundSeeder Rise, where we uncover what it really takes to go from an independent trader to an institutional manager. I'm your host, Emanuel Balarie, and each episode we sit down with some of the world's top traders, allocators, and mentors to explore edge, mindset, and what defines a true market wizard. Joining me today is Neal Berger, my friend and founder and chief investment officer of Eagles View Capital Management, a New York-based hedge fund platform he launched in 2005 to allocate to niche, uncorrelated trading strategies. Neal has more than 25 years of experience across trading, macro investing, and manager selection. Before founding Eagles View, he managed proprietary capital at Millennium Partners and traded derivatives at several major Wall Street firms. Today, Eagles View invests in a diverse portfolio of hedge fund managers with a focus on non-correlated alpha and risk discipline. So Neal, welcome to the show.
Thank you. Good to see you, Emmanuel, and happy to be here.
Yeah, always great to chat. I think for our listeners, it'd be great to know from the beginning, how you first got interested in trading and the markets and the genesis of your career.
Sure. Well, one thing I have to correct you on a little bit is it's no longer 25 years, it's 36 years now. So
Okay,
time flies and I'm getting a lot older.
it's been a while.
It's been a while. So I started in 1989. I think the movie Wall Street with the really good one, with Mike Douglas and
Yeah,
the original, um, kind of spurred my interest in the trading and that side of the world. I had done a number of internships while I was in college. Of course, the only thing I knew at that time was about Wall Street was being a stockbroker. So
right.
I was doing cold calling for Shearson Lehman, which if anybody's done that before, they know it's a pretty big slog. And then the next year, I did an internship at Bankers Trust in the real estate finance group, which was more on the investment banking side, which I also wasn't really a fit for, although it was a good experience. And then the last summer of my between junior and senior year, I did an internship at JP Morgan on the syndicate desk, which was much more trading oriented, and decided I have found my home. And also during college, there was something called the AT&T Collegiate Investment Challenge, whereby, let's say, 25,000 college students around the country were given a hypothetical portfolio of $500,000, 4 months, and you had to. The winners were the ones that could build that $500,000 up to as high as possible. And I came in ninth in the country,
Oh, wow.
so I probably fooled
I never
myself
knew
into
that. I
thinking,
never knew that, Neal.
yeah, yeah. I was in USA Today, and my roommate and I would run to there was no real internet back then. We'd run to the store, get the newspaper, and see whether I was made the top 10. And I had gotten as high as fourth at one point, but I ended up finishing ninth, and it made me feel like probably erroneously that I had some talent in the trading
Yeah.
business. And then from there, well, at that time, Japan was going to take over the world. Everything was all about Japan. And I went to SUNY Albany, so it's a good school, but it wasn't a school that was going to open the pearly gates for me in terms of, getting recruited in the best positions. And so I minored in Japanese language in addition to majoring in economics, just to differentiate myself from all the other economics majors that are out there. And Morgan Stanley was the best job that was recruited for on my campus. I didn't have particularly good grades, to be frank, but I did study quite a bit for that interview. And I was asking, in hindsight, thinking about the questions that I was asking were probably well beyond the scope of my interviewers.
Yeah.
So they were impressed that I had done that research, had understood that I really wanted to be in the Wall Street industry and specifically with Morgan Stanley. So I ended up getting that job in the 2-year analyst program. I was the only one in the program that was not from an Ivy League school. And, I spent 9 months there and decided I wanted to become a trader. At that time, Morgan Stanley, today becoming a trader doesn't seem all that difficult. You open up
Yeah.
a Robinhood account and all of a sudden you're a trader.
That's right.
Back then, when you're a trader at Morgan Stanley or Goldman Sachs, it's the elite of the elite. So the path to becoming a trader at Morgan Stanley was extremely difficult. But and he told me, if you ever become a trader here, it's going to be a decade, or, they were very discouraging
Yeah.
about, becoming a trader.
Well, let me just pause you there, Neal, because that's interesting. And really, that's the whole point of the podcast and FundSeeder, and it's actually great that you're talking about this, where like the pathway before to not only become a trader or to manage money is exactly what you are describing. Competitive, you have to be near Wall Street, and again, the vision of that we've always ascribed through with FundSeeder is, well, the world has changed, like you mentioned, with Robinhood accounts and the ability to study up and be focused and open up an account. And so it's exactly the sort of the pathway that we're creating at FundSeeder, and part of the reasons where we have had this process. So continue. I just think that's a fascinating point
Certainly,
that
no,
you're bringing
no,
up.
that's very true. I mean, 35 years ago looked very different than it does today.
Yeah.
And, in this business, one has to adapt, just like any trader has to adapt. It's a bull market and then it's a bear market, and, you have to be flexible to adapt. But because of my Japanese language ability at that time, I secured a trading job at a company called Fuji Bank, which at that time was one of the largest banks in the world. It has since consolidated into Mizuho. And my career has been a combination of preparation, some smarts, but also a lot of luck. So I just happened to be placed on the proprietary trading group at Fuji Bank. And, I had before I
Did
was
it
the
help?
age of
Did
20.
it obviously help that you majored in Japanese?
Yeah, I think it helped even though all these guys spoke English. They they were, and we spoke English for the most part. They were under the impression that I was able to decipher certain intonations from some of the big people that we were meeting, the vice chairman of the Fed or senior economists around the street, and that I could determine, what the guy was really saying between the lines, whereas they, as a native English speaker, whereas they felt they couldn't do that. And then I was able to translate that into Japanese and to put it, to make them understand. Uh, I think they overestimated that. I think it was pretty straightforward. But in any case, I wasn't complaining. So I had my own book, trading by the age of 22 because, Japanese banks were very different than Goldman and Morgan Stanley. The path to getting your own book was much quicker because it was just being a trader was viewed differently, like anything, you learn from the markets, so there was no course in school that I was able to take that taught me how to become a trader. I was very lucky that Fuji Bank at that time still had the concept of lifetime employment, so there
Oh,
was
wow.
no fear of getting fired, and it was a fertile playing ground for me to test out different trading. I had full autonomy, and if I lost some money, I lost some money. And that was really a great opportunity to hone my craft. And I spent 4.5 years there and didn't get paid much because that was sort of the downside of working at a Japanese bank at that time. But what it did do was teach me lessons I learned from the market enough to join what was then a little known hedge fund called Millennium Partners. This
Interesting.
is back in 1995. Millennium had 90 million under management, maybe 20 employees. The founder,
Wow.
Izzy Englander, was sitting across from me. Today, I think they have over 6,000 employees. And sometimes I ask people that are at Millennium, "What do you think of Izzy?" And they say, like, "I've never met Izzy," And I
Yeah.
have to understand that it's 6,000 employees now. It's not like the olden days when there was 20 people, and of course, you're seeing Izzy every day.
Yeah. And one of the things that makes you unique, and this is why I think this is such a great interview for our audience, is you've started off on the trading path as you're describing. I do want to learn kind of the key lessons and then talk a little bit about your time at Millennium. But you're also now obviously an allocator, which we're going to spend the bulk of our
Right.
time discussing. And I think that gives you a unique insight, possibly, probably in terms of the mindset of a trader that I would say most traditional allocators that are just focused on diligence or portfolio construction might not have. So, yeah, if you can, what are some of those key lessons that you had learned during your time at the Japanese bank and the learning years, if you will, post transition where you're now trading for Millennium?
Sure. I mean, Izzy Englander was an incredible mentor for me. His ability to manage risk, and I think that's what they're still known for. One of the key attributes that differentiates Millennium was, from whatever I've seen, unparalleled. I mean, he was the best seller that I've ever seen. Meaning seller firing a trader. His idea. He was trading traders.
Mm.
If he hired somebody, it's sort of like buying a position. If he fired somebody, it was sort of like redeeming from a position. So he was an incredible seller. He had no emotion involved. If he saw something he didn't like, or the guy hit a stop loss limit for whatever reason, the guy was out. And that Millennium still has that reputation today as being a high turnover kind of shop. But that risk management capability and the discipline really informed the rest of my career as I worked at Millennium throughout, for the most part, throughout the balance of the 1990s. That risk management, very tight risk management, um, stayed with me today as an allocator, and back then when I was a trader, of course. Not letting
Do you
that
think, Neil, to that point, I mean, do you think most allocators to emerging managers don't have that type of discipline? Because it's not like, you're putting in a trade, and let's say if you're trading in the markets and you have a stop and you're out, right? There's that risk management approach. But then when there's that human element of you're dealing with an actual person behind that trade, you know them, you've developed a relationship and it's time to get out is that almost like a more of like a rare quality in the allocator space?
100%. I mean, there's very few allocators I've ever met that have a trading background. Most of them came, from some Ivy League school, and they took out the AIMA due diligence questionnaire. And again, it can be a little frustrating for a younger emerging manager that hasn't, really established name recognition to crack that code, because one of the least important aspects of sort of an institutional allocator is the return.
Yeah.
They want to know, and if you look at their motivation, these guys, aren't getting paid a percentage of the great managers they find, so they're incentivized to keep their job. That's really what an institutional allocator is incentivized by. So they generally want to play it down the middle of the fairway. It's very safe to allocate to Millennium or Point 72 or Citadel. Nobody's getting fired even if those guys had a drawdown by investing with them. If they invest with a lesser known manager, they might get questioned by their board of directors, what business do you have investing with this unknown guy and losing money? So the institutional allocators have this very asymmetric bias because they don't get paid if they find great guys, and they have the risk of losing their job. Whereas if they go play it down the middle of the fairway, that risk of losing their job is minimized. So, but then there are people out there like myself that look deeper. What I'm looking for is really,
Yeah,
yeah,
let me to your point. I think one of the questions that I did have, and this is kind of how you view things of the type of managers and what you look for. We've talked often, and you've evaluated. I mean, how many hundreds,
thousands, thousands.
thousands of
Yeah,
traders over your career, and we talk about this idea or this word or this concept of edge. Like,
right.
does a trader have edge? How would you define edge to someone, right? Like when you say, hey, this, and then the two-part question would be, how do you evaluate it?
So, what I'm ultimately searching for is positive expectancy. And that is, I'm sure many of your listeners know, but that's that's better than a 50% chance of winning over a statistically relevant period of time. And so, in order to have positive expectancy, as you said, a strategy or a manager needs to have an edge or an advantage that allows them to overcome the negative expectancy that everybody starts off with. There's the commission cost, there's the cost of your infrastructure, there's crossing the bid offer spread. If you don't have preferential information, you have to assume that the person on the other side of the trade has a lot more information than you do. And so there's a lot of hurdles to overcome, including the fee structure that a manager is charging. So what gives you an advantage, or the strategy an advantage or an edge, as you said, that allows you to overcome those hurdles and generate positive expectancy and returns that are attractive to an allocator in a manner that has the right type of volatility and the right type of risk? And this is a very challenging equation to crack. And that's why most people don't make it. It's extremely hard. What I'm looking for in the quest for positive expect, I sort of view myself as a casino owner. And a casino owner has a house edge in every single game, as long as it's played honestly, every single game on the floor of the casino, whether it be blackjack, craps, roulette, whatever it is. So they know that over time, over a number of sample size, they are guaranteed to win on the gaming side. And in addition to that, the games are uncorrelated to each other. So if they happen to lose big on the slot machine, that has no bearing upon what's going to happen on the craps table or what's going to happen on the blackjack table. And so you have a large sample size of data points, and so they have positive expectancy. The player has negative expectancy. They put it together with a highly diversified series of non-correlated investments, if you will, or games, and it has both internal, lack of correlation and external correlation to the broader markets. So, what I'm looking for, and I'll pause because I can be long-winded, but what I'm looking for when I look at a manager is, in the quest for positive expectancy, what is your edge? Who's providing that edge? Because it's important to know, who. I invest in a market neutral way. Some people don't, but who is the entity on the other side who's providing you the inefficiency? So, for example, I'll just use a quick example: electricity trading. There's 3,300 utility companies around the country that are trading, buying and selling power, which can't be stored. So they have to go into the market and buy and sell power every single day, and their motivation is supply management. They get fired if there's a heat wave or a snowstorm and they didn't anticipate it. So they're much less concerned if they buy power $1 a megawatt hour more than the next guy, or $1 mega. It's a pass-through cost to the consumer. So there's a couple dozen people in that market that are trading for profitability. So you're trading in a soft playing field where you've got the edge providers and you understand why they're providing the edge, versus a limited amount of edge takers. So the demand supply equation for sophisticated players or motivated players to generate profits versus motivated players to generate supply management is asymmetric. And so that would be an edge. So what is the edge? Who's providing the edge? Why are they providing the edge? So, I just explained that they're going to lose their job but they don't care if they're paying $1. How long do we expect that inefficiency or that edge to persist? Which is probably the least important question, because it's hard to get it right. I thought statistical arbitrage would have died in the late 80s. Nunzio Tartaglia at Morgan Stanley invented it, or was the pioneer of it, and it was still going on in the 2000s. And today there's still a strategy called statistical arbitrage, although it's been evolved. So we never know. And for me, if it's 6 months, it's 6 months. I'll play it for 6 months. And the edge degrades, then I have to get out. So how long do we expect the edge to persist? But very importantly, what is it going to look like to me when that edge does dissipate? When it dissipates, am I going to have to lose 20% to realize that the inefficiency is no longer there and the edge degraded? Or is it like flipping IPOs in the late 90s during the dot-com era, where the banks were on the bid side to support the deal at the offer price? So if you get an allocation, it's either you make money or you break even.
Yeah.
But then when the market crashed in the NASDAQ, there were no more IPOs. So we took our chips off the table and looked for other opportunities. And then finally, does the practitioner have the background, the experience, the knowledge, the track record to capitalize on the inefficiency or the edge that they're seeking to capitalize on? And those are the broad questions that I'm asking myself whether I want to invest in that manager or not. And then, of course, there's a lot of other hurdles. How does the manager manage risk? And, what is the expected return? What is the cash efficiency? What does the operational due diligence look like? So, the pyramid gets very thin as you start off with a lot of candidates. When you finally make the allocation, it's really a thin, pool
Yep.
of candidates.
Let me ask you a question. I mean, in my experience, and I don't know if you've experienced the same, but oftentimes, let's say I speak to a trader and there's edge there, right? And let's say his returns justify that, they show it, you kind of understand it a little bit. But the trader himself really has a difficulty articulating his edge. Like it's internalized in his mind, or he hasn't really had many one-on-one conversation with outside investors or other allocators. What are like just some quick points, right? And have you experienced that? And then have you come across that, or is it no? If a person can articulate his edge, then I'm already out. So I'm kind of asking multiple questions here, but really, what are some quick sort of here are 3 points of how you can work on articulating exactly your edge that you think you have?
Sure. Well, number one, it's important to understand why you have an edge.
Yeah.
I mean, the track records that you see, and I'm just speaking for myself. Other allocators do things differently. The track record that you see is a non-statistically relevant sample size of data. So even if somebody has 10 years of track record, maybe it was in the last 10 years, which has been a raging bull market. All they've been doing is buying the dips or selling volatility, when it spikes. And so is that really an edge? Not really, because they're just, sort of fortunate to have the right strategy at the right time. And they have to be intellectually honest with themselves that, I've been playing in a playing field that has been very fertile for what I do. And then the question becomes, can I adjust? Everybody thinks they can, but, can I adjust to a different type of playing field? So I think first the manager has to understand what his or her edge is. When I ask the managers, what is your edge? I can't tell you how many times I get the answer, well, I graduated MIT at the top of my class, or I graduated Harvard, or whatever the school is. I work 17 hours a day. I speak to management. I speak to the supply chain. That was an edge 30 years ago, before Reg FD, before the advent of AI, before the advent of algorithmic trading. You're competing against the smartest robots in the world. So, being smart, being hardworking, doing the common things that, as I mentioned, are table stakes in this game. You have to really do something that's differentiated, whether you're getting information flow that is not able to be easily obtained by the rest of the market participants. So I think that the manager has to understand his edge, has to be able to articulate his edge, and has to be able to articulate when, what periods are going to be good for the inefficiency that you're trying to capitalize on, and what inefficiencies are going to be more challenging. So, for example, if you have a volatility arbitrage strategy, one would expect that strategy to do better during higher volatility regimes. There's just more inefficiency in the option market during a higher or more normalized volatility regime versus a VIX 10, which we saw for many years. I would expect that volatility manager to be flat. Hopefully they're not losing a tremendous amount of money. Up or down a few percent is fine, because we understand that this is not the most fertile environment for this manager. If that manager were to say, "Hey, we're up 20% even though the VIX is 10," that would be a red flag to us. It wouldn't be an automatic redemption, but we'd have to go and see the manager and understand what is it that we missed, or what is it that the manager is doing that was not articulated at the outset. Maybe he's selling options now, which is not a strategy that we're looking for. I would say those are the three things that
Excellent.
manager needs to be able to do.
Yeah, that's very helpful. Really, very helpful. So, one question, it's almost going back a little bit, but I'm curious, and then we'll dive back into some of these insights that you have in terms of evaluating managers. What made you transition from Millennium and being a trader, obviously being mentored by Izzy, understanding how he does it, to actually starting Eagles View?
Sure. The game changed. I mean, the way in which I used to trade, and I'll use some people that I'm not in the same league, but Paul Tudor Jones or a Stan Druckenmiller, some of the guys, discretionary pattern recognition, essentially looking for large trends in the market. That's antiquated. John Henry was one of the biggest CTAs, back when, and he ended up buying the Red Sox and retiring from trading. So this industry is constantly evolving. And to be frank, what I was doing was no longer working. And so I had to adapt and apply. I look at myself as I can't say a trader of hedge funds because that connotes a more short-term oriented situation, but I'm a portfolio of hedge fund securities. A hedge fund is a security, and so again, to use the example I used before, if I'm allocating to a manager, I'm essentially buying that manager. And if I'm redeeming from a manager, I'm essentially selling that manager. Although, in the hedge fund format, you can't do it, day by day. There's usually a quarter or so notification period and things like that. So that's why I consider it more portfolio management. So applying the same skill set that I had when I was a trader, which no longer works given the advent of algorithmic trading and AI recently, just greater sophistication. When I started in the hedge fund industry, there was collectively $50 billion in hedge funds. Today there's north of 5
50 million?
trillion. 50 billion, 50 billion.
50 billion.
But today there's north of 5 trillion.
Yeah.
So imagine how much money is chasing a finite amount of inefficiency in the world today versus 30 years ago. Playing field has just become much more competitive. You have the smartest people in the world with the highest powered computers with millisecond latency. And, I just can't compete in that kind of an environment. So I had to pivot and find a way that I can compete, which I think is paramount for a trader, is to understand, when they need to adjust their model or even, fully, just change what they're doing completely to adapt to the new market environment.
Is that something where you've had historically, let's say, I mean, it's interesting you say that where you're interviewing traders articulated their strategy, their edge, you've made an allocation, and now the environment has shifted. And what's the process? I would imagine that if they come to you and they speak to you as an allocator and say, Neal, like this is what's happening. I'm not sure this is working. I think I want to try this new approach. What do you think as an allocator when that type of conversation happens?
I am personally, and again, like I said, everybody is different. I don't have the time for that. In other words, I need somebody to have proven that their new strategy has what I've mentioned before, positive expectancy, has an edge, and be able to articulate why it has an edge and to prove it out a bit. We have green fields as to who we can allocate to. Just to use as an example, if I have $1 million to allocate, why would I give it to somebody that's trying something out or testing something versus giving it to a proven entity like Point72 or Millennium, or name any of the others. So I have to look at my opportunity cost as to, do I want to back somebody who is just learning and has an unproven strategy, or is my capital better used elsewhere where I can come back to that guy once he's proven his ability, which is probably
So,
not the
and
greatest
that's
answer
and
for
that,
a lot
yeah,
of.
that's a fair point. And I was bringing that up because I mean, you were saying, look, if the strategy no longer works and you have to adapt. And so sometimes some of the most, I would say the better traders are the ones that are self-aware, right? Like, hey, the regime has changed. If they approach an allocator and start changing the regime, or I mean, changing, saying their models or how they're articulating it, it's game over, and that's okay. Like, but instead of just not doing that, I guess that was my point that I was making.
Well, what I've typically seen is managers not completely making a 180-degree shift. They're continuing to do what they do and then transitioning slowly. Like, we're going to test this other
That's good.
model that sort of rhymes with what we were doing. But, I give you an example. So in the electricity trading that I mentioned, it was a great strategy for 20 plus years. But now with the emergence of renewable energy, it's changed the nature of the power grid. So managers that were able to utilize quantitative skills in terms of trading the electricity grid are no longer able to do that because the data that they were using didn't account for the emergence of renewable energy. And so the playing field changed. So I have to get out of those strategies as the edge is degraded. Now they may say, look, I have great skills in this electricity trading. I'm going to, nat gas has a lot of correlation to electricity trading. We're going to allocate 10% of the portfolio to nat gas basis trading, and we think that that's less affected by the renewable energy. So and then we see how that does. So, in those cases, as long as the guy is not losing a tremendous amount of money, hopefully he's still making a little bit of money on the core strategy, but we may be willing to see, like, if he makes a compelling argument as to why he or she believes that uh this is something in their wheelhouse that they're capable of doing. Electricity guy says, I want to start a relative value credit fund.
Yeah.
We're going to be, not with my money.
Yeah.
So, but if it's something that rhymes and we can believe the story and we believe there is an efficiency potentially in this new strategy that they're testing out, we're willing to see them test it for a little while on a small amount of capital. And then if it works, a little bit more, a little bit more, a little bit more, and ultimately it may become the dominant strategy if it really does work.
That makes sense. What brings to mind, I had years ago, I had raised money for a manager, and we were in a lunch together with the manager and the allocator. And I remember clearly that the manager said, "Well, I'm going to do a new strategy, or I'm going to try something new." And like in the moment, I thought to myself, "This is over. The redemption is coming." Like,
Yeah,
and
I mean,
sure
we
enough,
thought,
it happened, and that was the right thing, right? And that was indeed the right thing. So, yes, kind of moving on a little bit, like those are like
I would say in
mistakes. Yeah,
in our industry, as you know, we would call that strategy drift.
yeah,
There's a word for that, right? Strategy drift.
yeah.
So anyway,
And
so sorry.
g- the moving on to sort of how you evaluate managers, and the point and the focus of this podcast is to help those who are traders and are looking to scale and become institutional managers, right? And just in advance not make some common mistakes, because I've been there before where sometimes I might say something, I'm not even like, and then it just comes out and it's like, well, I was just thinking about it, but once it comes out, the investor, the allocator, for them, that's a big flag and a big concern. So, what are some other common mistakes that you have seen emerging managers make when they first approach, institutional investors like yourself?
First of all, I think they need to know where their marketing sandbox is. You can't go approach Blackstone with a 2-year record and you've been trading $1 million. For those kind of people, and people, Greenlight Capital was started with $1 million in 1996. Maybe it's more difficult today, but those kind of people have to understand that their market is going to be high net worth individuals, people that may know them, or even people that may not know them that believe the story and say, well, I'll chuck in 250,000. You seem like a good guy. It's, you got a good track record. Let me see how it goes. Right. So you don't waste your time pitching the larger institutions. Focus on where your time and energy is going to be most well utilized. Um, Another one is often skin in the game. That's not an absolute dollar amount. If a guy is worth $100,000, it's no problem as long as he says, I have expenses, I have overhead, I got $100,000 in the bank. I'm going to put $70,000 of that in this fund or in my strategy because I have a lot of confidence in it. It doesn't matter whether it's $70,000 or $700 million. It's meaningful to that manager, and he's willing to bet on himself. So, and there's obviously the cost of infrastructure and all that. So, an allocator wants to see that the manager is eating his own cooking, to a large extent. I mean, there's so many pitfalls that managers can, and what I would also say is in the early stages, 1 month can ruin you. Meaning, an allocator like myself, looking at the track record, looking at the qualitative analysis part, where what is the edge, what is the inefficiency, what are my return expectations? Let's say the return expectations are 12% a year, right? If you lose 10% in a month, you're done. So you have to understand, and that will live with you forever. Where investors will, if you survive, investors will say, "How come you lost 10% in 2025? Here it is 233, but they'll still come back to that large monthly drawdown." Keeping the drawdown appropriate relative to the expectation of the return profile, which finger in the air, I would say, is about 1/3. So if somebody has an expectancy, and you have to be intellectually honest with yourself and say, what is my expectancy of return? And let's say it's, again, 12% per annum. Um, you know, Basically, I shouldn't have more than a -4% handle in any given month. Otherwise, if you have more than that, it tells the allocator you have poor risk management capabilities, or you don't understand your market very well. So those are some of the mistakes, and there's certainly a whole litany of
Yeah.
them.
Well, on the
But
flip side of what you just mentioned, and totally agree, but the flip side of the coin, and I've seen this, I'm curious how you've seen it and how you approach it, where a manager gets the allocation and now they're trading other people's money, or it's the big first institutional account, and they are uncomfortable to take the same amount of risk because they don't want to have that drawdown. They don't want to lose that account. And maybe psychologically they just they no longer trade how they used to trade, which is a key component, right? And instead they're more conservative. They're sort of, their profile has changed. And how do you deal with that, where it's the opposite side of
sure.
what you just described?
Well, they shouldn't be playing at a level that makes them uncomfortable. I can make an analogy to poker. So poker, let's say your comfort zone is to play at the 1-2 game. Maybe $1 small blind, $2 big blind. And then you get thrust into the $100, $200 game where $100 small blind, $200 big blind, and you could be put to the test on for a $500,000 bet. You can't play. You're gonna play differently, and whatever your edge is not going to be able to present itself as if you're playing within your comfort zone. And it's not to say that you could never get to the $100, $200 table. It's that you want to go from the 1-2 table to the 2-5 table to the 5-10 table. You want to make a gradual progression. But my first trade, I lost $5,000. And I said, and I'm just a kid coming out of college. And, at that time you could buy a Hyundai for $5,000. And I was so upset about it. And one of my colleagues was like, Neal, you look upset. What's the problem? I said, I lost $5,000 today. I'm so upset. And he said, he kind of chuckled and he said, you know the way to get past losing $5,000 is lose $50,000, and then you won't worry about losing $5,000.
It's funny.
And then get over losing 50,000, lose 500,000, because you start to build confidence that you'll always come back if you've got the positive expectancy and the edge. So, and I'm not advocating somebody experience extreme losses, but you have to trade within your comfort zone. So an allocator would not look favorably upon any changes to what they bought. So they're buying something, and if that's what they're buying, that's what they want. You may be running your own money at 10x leverage because you're comfortable with those kind of swings, but an institutional allocator may say, we're happy with 10% a year returns, but decrease your vol dramatically and trade at 1x leverage or
Yeah.
1.5x leverage. We don't want to see a drawdown of more than 5%, or on a monthly basis, 2.5%, whatever it may be. That's okay. You can just adjust your trading size.
Yeah. And what I've seen in some of the better emerging managers and traders is they are self-aware to know this is I'm going to play at this table. So even when speaking with us as allocators, and like, I could only, let me first trade an additional 10 million or an additional 5 million. And then at that point, I will analyze further. Sure, the depth of the market is deep. There's liquidity, but I won't know until I get there. And that's actually a quality and a trait that I've seen as that fits some of those that are successful, and they can move on and manage additional capital.
Right. And we've redeemed from managers that they didn't understand the capacity of their strategy. And that they grew too big for the liquidity that the strategy has. And we redeemed. And most of the time, in hindsight, that had been a good decision. That it's seductive to want to take in another 100 million or another 500 million or whatever.
Yeah.
Hard to refuse because you remember the days when you were trying to take in 500,000, and now somebody's offering you another 500 million, and it's very hard to say no. But you really have to understand the slippage that you're going to incur or the real capacity of your strategy. And an allocator wants to see that. It's sort of, it balances naturally because nobody's getting a $50 million allocation from an allocator if they're running $2 million, in a strategy that they don't have a lot of experience in. The allocations tend to come in line with the amount of AUM. A lot of these institutions can't allocate more than 10% of the AUM of a fund. So if you've got $10 million, all they can do is put $1 million in.
Yeah. No, and I'm curious because that was follow-up question I was going to ask you was specifically about capacity and scalability and your philosophy behind that, which you just touched upon. When it comes to redeeming, right? Um, and you mentioned one, which is okay, this manager is now becoming too large. Maybe it's no longer efficient. Their risk management or their return stream is not similar to what it used to be. What other have you had experiences of other more like intuitive, like as a trader, where you can't really quantify, hey, this is the reason why, but I feel like we have to redeem from this trader or manager. Maybe you could share a story or two from that perspective.
Yeah. So although I was a macro trader, uh, I'm not in the prediction business. Okay, so I'm not trying to predict how many times the Fed is going to lower interest rates or whatever. I'm in the observation business. So there's things that you can observe today. How Japan has gotten so much more exciting after it crossed its 34-year high water mark in April of 2024, which has brought in a lot of unsophisticated players, and the sophisticated players left those markets 25 years ago. So it's fertile playing field to operate. So this is an observation rather than a prediction. We decided at one point, I think this was back a number of years ago, that quant had gotten very, very crowded. A quant is trying to get their edge from less sophisticated players, generally retail investors. And so if there's too many quants, it's like professional poker players playing against each other. You don't want to, have the robots taking money from robots. You want to be playing with accountants and lawyers who play once in a while. So, we decided that quant was too crowded, and we got out of the majority of our quant. Now it could come back, and we have been allocating a little bit more to quant as that part of the industry flushed itself out. The emergence of the meme stocks and the power of social media, Reddit, and everybody knows these stories with GameStop. I mean, this is now something that we need to consider, whereas we never had to consider this 10 years ago. So it's observing the landscape and understanding what the manager does. I wouldn't invest with a manager that's selling a stock that could potentially be a meme stock, and it is probably overvalued at $3, and they're selling it because of fundamental reasons, but that stock is trading in a way that it could go to $300 before it goes to $1. So
Yeah.
we have to understand the changes in the playing field.
So what are you seeing now thematically? I mean, what type of, I mean, you mentioned quants coming back a little bit. Are there specific strategies that you're sensing, there's potential, inefficiencies and like you have your eyes out. Like what are those thematic strategies that you're looking for?
Sure. Well, as I mentioned, we pivoted quite a bit to Asia, where, and specifically Japan, where I think there's a lot of inefficiencies there. And it's also a good sandbox for us because it's a country with good rule of law. They have deep and liquid capital markets. We're not worried about the safety and return of our capital, whereas we've never done anything in China because we're not as comfortable there. We did allocate to a manager in South Korea. And we got to understand these guys have a very specific edge that we understand, and there's not a lot of competition for what they're doing. They've sort of built a moat around their edge. So, other than that, obviously everybody is sitting and waiting for how AI is going to infiltrate the trading systems and how it's going to change the trading landscape. So far, I have not seen anyone who is just using AI and they're making 100% a year and they're just running circles around everybody. It has not evolved to that level where artificial intelligence, at least the ones I've seen, artificial intelligence is becoming such a useful tool that every manager is utilizing it. It's a big buzzword, of course, and artificial intelligence, I'm sure, is here to stay, but it hasn't yet translated into tremendous profits from managers that are utilizing it, although we're on the lookout for when it does, when it evolves enough that a human being can't beat it.
Yeah. That's great. Those are excellent points. Earlier on in the podcast, Neal, you had mentioned, the industry was at 50 billion and now it's scaled. I'm curious your thoughts on the talent wars right now that are out there. And you've been a strong advocate, of course, for undiscovered trading talent and just looking at emerging managers and you've been a big fan of obviously of what we've done at FundSeeder and a friend throughout this journey. Why do you think it's been so difficult for the smaller players and the emerging managers to break through, and yet there's still the bigger shops, the millenniums of the world, focusing on talent wars and just the general inefficiencies of the flow of up and coming talent, and then being able to transition to become more institutional managers.
Sure. Simply put, because Millennium, Citadel, Point72, Ali Asney, D.E. Shaw, that first tier of managers in the multi-strat game can afford to buy anybody they want. So if there's, and they know everybody on the street. So if there's a rock star trader at Goldman, everybody knows who he is, and he's generating $250 million a year in P&L. And why would they, they have Millennium, for example, has $80 billion under management. So they won't allocate less than $500 million to a manager, or maybe 250. That's my opinion. I don't know factually exactly what the number is, but it doesn't move the needle for an $80 billion allocator to allocate to a strategy that has less than a couple $1 billion in capital. Now, how does an emerging manager crack that code? It's sort of like being a minor league ball player.
Yeah,
You
sure.
have to succeed as a minor leaguer. You have to, you have to show yourself. Then maybe you get called up to the majors. Okay, the majors might be Goldman or Morgan Stanley or Merrill or whoever it might be, and then you have to succeed there. How do you become a Hall of Famer? Because these guys are looking for Hall of Famers. You know what I mean?
Yeah.
They're not even looking for major leaguers. They're looking for Hall of Famers, and they can afford to buy those Hall of Famers. I think it was in the press a few days ago that Millennium gave a manager $100 million signing bonus.
Well,
And divided by an $80 billion capital base, it's really not that much in terms of and because they're competing against Citadel, Point72, that they themselves could write $100 million signing bonuses. And I'm sure the guy that they gave it to is just, they have high expectations that he's going to generate, probably billions of dollars in P&L. So generally, an emerging manager has no experience in terms of trading the size or no history that would qualify for one of the larger multi-strats in trading the size that a Millennium or a Citadel would require. Now, there are plenty of smaller multi-strats, the second tier, third tier, the ones that have 5 billion or 2 billion or 3 billion, that are higher. They can't compete with Millennium either, or Citadel. They can't hire. If you're looking for A players and Citadel wants somebody and you're a $2 billion multi-strat, you're not getting them. You know what I mean?
yeah,
So they have to, try to find strategies that are either too capacity constrained to be meaningful to the larger multi-strats. Maybe they have $100 million capacity. The bigger multi-strats are not going to hire that guy because it doesn't really move the needle, but a smaller multi-strat might. But even the smaller multi-strats, there's a lot of competition for the talent. But that's why if you make it in this business and you get to the top of the pyramid, it's so highly compensated. I mean, it makes professional athletes look like paupers,
yeah.
so it's tough, but the rewards are there and the risks are there. So,
That's
you got to have
great.
a lot of confidence in your edge in
Yeah.
order to play in the game.
And what you mentioned earlier as well, which is know exactly the type of investors to approach and not approach those where you don't even have a shot. So one final question and then a few just quick rapid fires. But looking back at your own journey, what would you tell your younger self when you started trading for Fuji Bank and Millennium? And like if you would through the learning lessons, like what are just some key tips when you started off that you would say, hey, these are the most important thing. And it could be about trading and it could be about life.
I should have stayed at Millennium. And I should have adapted my strategy to whatever it was that was working, because Millennium grew from, I think when I joined, it was $90 million under management to 80 billion today.
Did you get stopped out of Millennium? Or did Izzy just pull, or did you decide to go to the opposite side and where the greener fields?
So what happened was, towards the tail end of working at Millennium, I was flipping IPOs because this was during the dot-com craze. And these are relationships that Izzy and his colleagues had that I was sort of given on a silver platter. And that business died. Like I said, with the bursting of the Nasdaq, there were no more IPOs to be had. And so, and at the same time, I noticed how strategies had become much more sophisticated. I don't have a background in quant trading or anything like that. And so fortunately, I'd made a fair amount of money for myself at that time. And I decided that I knew enough of these smart, under the radar, capacity constrained strategies that instead of doing it myself unsuccessfully, I could allocate money to these guys who are experts in these niche strategies. That's one. And I think the next biggest one is trade small. There's a temptation to trade when you have a lot of conviction in a strategy in a trade to get big. It's a big mistake. If you whatever you think your position size should be, cut it in half because you have more staying power because as great as you think the trade is, it's going to go against you, and then you're going to feel and it's going to go against you more than you ever imagined it will. Then you're going to feel the pressure. You always want to play on your front foot. You want to be able to play offense rather than defense. So you're going to feel the pressure of all you're thinking about is how much can I lose and where do I have to stop myself out rather than saying, hey, I know this is part of the movements of the market. Maybe I'll buy a little bit more here or add a little bit here. And you can only do that if you trade small. So I've made that mistake throughout my career. I wanted to trade big when I had a conviction in something, but it's a mistake. Trading
Yeah.
small, you can make as much money or more because, how many times do you have a position on, it goes against you, get stopped out, only to see that position go back to, in the way that you thought it was going to go. So if you're trading small enough, you have more staying power.
That's great. That's great. Okay, some rapid fire questions. One book that you would recommend for traders or for audience to read?
Well, of course, I'm going to say Market Wizards. I've read all three, and there one could look at them as interesting stories. But what I look at, I've read them a number of times. What I look at is what is the commonality? What is the common thread between all of these successful traders that you can discern? And they've all tended to have very tight risk controls or I haven't read them for a while, but there are commonalities between all of these successful traders that if you read it over and over again, you keep hearing the same theme. Another great book is Reminiscence of a Stock Operator. Uh, I've read that 3 or 4 times. That is sort of the Bible of it's a story about Jesse Livermore in the 1920s, and it's a real story. It just goes through so much. The more you read it, and if you're a trader, the more you appreciate the nuances of that book. And then the last one I'll say is The Alchemy of Finance by George Soros. He goes into his whole reflexivity theory and all that, which is a little bit theoretical and kind of hard to follow. And then the second part of the book is what he calls the real-time experiment, where he go day to day, he tells you what he's doing, why he's doing it, what his thought process is. And so I found that fascinating because Soros doesn't trade anymore. But at the time when I grew up, he's a phenom. He's Babe Ruth. So you want to understand what it is that triggers a trade and what it is that when he gets out, when he gets in. He's famous for saying, if my back is hurting, I know I'm in the wrong trade. This is
Yeah.
like little cues like that the body will tell you, that you're uncomfortable with this trade. So it's fascinating reading, but I would say skip The Alchemy of Finance in the beginning, where he goes into all the reflexivity. If you're not inclined to have a lot of confusion, and just skip to the real-time experiment, which is about half the book, where you see every trade he does and why he does it.
Okay. Two more quick questions. When you have a winning trade or you're successful or you had a great quarter or you're happy, what do you do to celebrate?
Look, I'm not a partier. I have a wife and kids. I'm 57 years old. I mean, my idea of celebration used to be going to Disney World with my kids. We're going to go to Japan like in April. The reality is, when you've been in the business 36 years, realize you're going to have you. A trader once told me, you're never as good as you think you are, and you're never as bad as you think you are, which means there's going to be periods where you're going to do so well, you think you're the biggest rock star on the planet. You can't do anything wrong. And it's not a smart move to get too high on yourself at that point. Is to temper it. And then there's times when you're trading when you think you can't do anything right. It's like, I don't know why, but I suck at this. I'm going to have to be driving an Uber, after this.
That was my second question, right? Like, so basically, you're telling me you're more even keeled in this
Yeah, you need to be.
day and age. And the second question was, what do you do when you're having a rough day, a rough month in trading? What did you do? Like, what are the things that that you do in that situation?
I go home and cry.
Yeah.
I'm just kidding. Maybe no, I don't. It's the same thing as having a great, it's very hard to do emotionally. I
Yeah.
understand that what I'm saying is exceedingly hard to do. And traders, the best ones, have trained themselves to be what you think is an intuitive situation. For example, it's intuitive to say when a market goes down, it's cheaper and I want to buy it. When a market goes up, it's more expensive and I want to sell it. I mean, that's the intuitive way. But nobody invests like that anymore. When the market's going up, they want to buy it, and when the market's going down, they want to sell it. As it's kind of trend following. But it's not really an intuitive thought process. So, you gotta if you have my boss at Fuji Bank, Mr. Sakai, who is the head of the trading room, this guy, and he was swinging $100 million a day sometimes, maybe $50 million. You could not tell if he had a winning day or a losing day. His attitude and his demeanor was so even keeled that you just couldn't tell if he had a great day or not a great day. And I think because he was so in the market for so long, he learned how to smooth out his emotions to understand that, listen, I've been through this before. I've come back. Do I have an edge? It's like, you know, to use my casino analogy, if somebody came in and pulled the super Powerball slot machine for $50 million, I'm being hypothetical, would the casino say, "Oh no, we suck. We're going to go out of business"? They would say, "No, listen, it happens once in a while, but I've got positive expectancy. The math is on my side, and if I keep going in this, more and more observations, I'm going to end up winning despite short-term losses."
Yeah. Well, you're a seasoned pro, and I think I'll amend my question for future podcasts where I would be like, when you were younger and you were dealing with this, what would you do to walk away? But Neal, thank you so much for
My pleasure.
being on the podcast. Really appreciate your insight. I think it's going to be valuable for this next generation, those who are aspiring to grow and to rise to next steps. Really appreciate having you on. We'll put a little bit more about Neal in the show notes and a link to his firm, but I appreciate you being here on
Pleasure.
this
Can I
podcast.
just can I just add one thing,
Sure.
Emmanuel, which I think I forgot and it's important. I think new traders, young traders should try to find opportunities and inefficiencies in playing fields that are not saturated with players. So for example, to try to be yet another long short equity guy when you're competing against, robots and people that have 30 years of experience and people that have preferential information is a very tough place to crack, where you can find an edge. If you become an expert in shipping derivatives, there's less competition in those areas, or uranium trading or lithium or whatever it may be. If you look for those opportunities in less well-trafficked areas, it's going to be a lot easier to become an expert in those areas and trade successfully when there's not as much competition as there is in straightforward type strategies.
I think that's excellent and brilliant advice for the younger generation for sure. I'm just thinking even about my son who's 14 and wants to learn to trade, and you have a bunch of YouTube videos of people promising to make tremendous amount of wealth. And I think what you just gave in terms of pearls of wisdom is absolutely excellent. So thank you, Neal, and thanks again for
My
joining
pleasure.
me today.
Always a pleasure, Manuel. Nice to see you. Thank you again.
Thank you for joining us on the FundSeeder Rise podcast, where we spotlight exceptional independent traders from around the world and explore the future of active money management. To learn more about FundSeeder, our mission, and how we support emerging managers globally, please visit us at fundseeder.com. The information shared in this episode is provided for educational and informational purposes only and should not be considered investment advice or an offer or solicitation to invest in any fund or trading program. Trading futures and other derivatives involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Until next time, stay curious, stay disciplined, and keep rising.